is we are the world's largest independent valuation and strategy firm. We are the only triple certified firm. So we have 2 ISOs and the MASB certification for all the work that we do. The values and rankings that we publish are also the world's only ISO compliant brand values that are published. They are also certified by MASB as a true measure for marketing accountability and ROI. So do keep that in mind when you're sharing these internally about how important these are from an external point of view as well. IVSC, so we follow the IVSC recommended methods, etc., for the valuation. We remember talking about the 2 ISOs within the valuation. One is ISO 20671, which is a more recent one, just announced 2.5 years ago. That talks about the evaluation, which is the brand strength index part. It looks at what is the strength of IP, how well it is performing, etc. The brand valuation is ISO 10668, which was announced a few years ago, and that looks at the monetary value calculation of the brand. Primarily looking at 3 areas. One is the trademark and ownership area, so the legal analysis. One is the market and consumer behavior analysis, which also goes into the evaluation and the brand strength index that we do. And the third part is the financial analysis. So if you don't do any one of these, then it is not an ISO compliant analysis. And similarly, the second ISO that's in use within these rankings, the brand evaluation. Just a quick crash course on the valuation. There are 3 ways primarily to value anything. There's a market approach, cost approach, and an income approach. Quickly explaining it in layman's term, the building that all of you might be housing your office in, if you were to buy that building and use a valuation technique using market approach, you would see what is the going price of the nearby building, and you will use that as a benchmark. If you were to use a cost approach for the same, you'll then start to calculate the cost of land, the cost of construction, the kind of time it's going to take to construct all the furnishings, etc. And then you'll say, all right, that's your benchmark, is total cost. So the cost to replicate is used as a reference point. The income approach looks at what is the income generation ability of the building after you buy it. And the brands are valued using the income approach. Under income approach, there are, as you can see, there are multiple methods, direct and indirect. We use royalty relief approach, which looks at fundamentally, if you did not own the brand and you had to pay an external third party to use it, how much would you have paid? And by the way of owning the brand, you're actually given a relief from that royalty. So that's why it's called the royalty relief method. So this is just for you to explain to someone internally. Should there be questions? Should there be some other areas that you might be required to explain when you take these rankings to some of the other people within your organization? How is it calculated? We first set out to assess the strength of the brand. So when you actually see the ranking and the value that we publish, you'll see a brand strength score. That's a score out of 100. The higher the score, the stronger the brand. It goes on a rating reference of AAA to triple D, AAA plus, AAA minus, then AA plus, AA minus, then A plus, A, and it goes down all the way. There's not a credit rating of any sort. There's a brand strength rating. So if you see a AAA plus in front of your ranking, that basically means your brand ranking score would be more than 80 and keeps going down. So there are different slabs of it. We can share the details with you, whoever's interested in knowing more about it. That brand strength index is applied to the royalty range. The royalty range is a complex calculation looking at the kind of businesses that you operate in, etc. So there's no one size that fits all. There's no one number that will apply to banking. There's no one number that will apply to all the airlines or all the telcos, for example. There will be differences between them depending on what contribution they're getting from which part of the business. So again, someone might say, oh, but I'm so much bigger than A. Why is my value low? The answers would lie in looking at the details of it, which can be made available on request. So royalty rates, a stronger brand will apply a higher royalty rate, a weaker brand will apply a lower royalty rate. That royalty is then applied to your forecasted revenue. So again, it's not so much about your historical performance. That does give us the baseline. So if your baseline is, let's say, 10 million and I'm forecasting 5% growth on that, it will give a different number. If your baseline is 5 million and I'm forecasting 5%, it will surely give you a different number. So the baseline is very, very important. Your current performance for the past year does play a role, but historically, whether you're loss making or profit making doesn't really play as large a role as your future performance does. If your forecasts are strong, if you're going to grow in the future, you would have a higher value. And that's how the value is calculated. We use the discounting factors, we apply the tax rates, etc. And what you get in the end is the value of the brand. So it's a fairly robust process. What are we valuing? There are different types of tangible and intangible assets as per IFRS. So what we're valuing here is the marketing intangibles only. You may have a lot of other different types of intangibles in the business, like customer intangibles, contracts, technology. A lot of you might have patents within the business. What we're valuing here is a trademark. Not to say that other intangibles don't have any value, but when you look at the value of a company historically, that's actually made up of these two assets, the tangible assets and intangible assets. And I'll share in a while what kind of benchmarks are there, because we do also run a very large global study, which is called the GIFT, Global Intangible Financial Tracker, which tracks 57,000 companies across 128 stock exchanges around the world each year. So that's, again, a very, very useful analysis in case somebody would be interested in that. And there you will see what is the kind of difference between tangible and intangibles across variety of sectors, variety of geographies, and so on. So coming to the top 100 brands in Malaysia. That's what I was talking about earlier, Invest magazine. It's a e-magazine, so very easy to download, very easy to read. If you want to scan the QR code, now would be a good time to scan it, or you can do a print screen and save it and then scan it later. I will share it once again towards the end. And that's where you can get the full values for all the top 100 brands just for a very short period of time. On our website, it's usually in a locked mode. So after the top 10, you may not be able to see the rest. But just for a very short while, just for the next few days, Invest magazine will have all the values published. After that, they will also be removing it. So it would be a good idea if someone down the ranking wants to know the value of the brand. Well, you can either write to us, but I would say a quicker way to do that would be just go to the website. You can also go to brandfinance.com for it, and that would be, and write in to us, and we'll get back to you. I was mentioning the GIFT, which is Global Intangible Financial Tracker. The new version is going to be launched early September, so in a few days' time. But if you look at it historically, the tangibles and intangible difference is what we're tracking. And globally, almost 48 to 52% of all companies' value has been in the intangible historically as well. So here, if you'll see, 42% is tangible and the rest is intangible, disclosed, undisclosed, both being there. What does it mean for all the different entities and all the different geographies? There are entities where this percentage will be as high as 80% or 90% because they don't have a great deal of tangible assets. So if you look at the new age companies, the Airbnb of the world, the ones that are very technologically dependent, their IP is in the brand or in the technology or in the customer database. And so those are their IP, but they have very little tangibles. There it could be as high as 80% or more. So coming back to what does it mean is, if your tangible to intangible are, let's say, 50%, and the management has very little sight of it, that basically means the company is managing only one half of the business. The shareholders and the investors are actually paying you for the full value. But because 50% of the value is in the intangible and no one has a good sight of it, or no one knows how that goes up or down, or no one really is tracking that on an ongoing basis, that's not a good idea, because then the management is only running half the business from an investor's point of view. There has been a misconception again, and or a misplaced notion that if your share price is going up, everything is good and fine, and that means that your values are always increasing. Not necessarily the truth. The two have very little to do with each other. Your share price going down or your business value becoming zero does not mean your brand value will also be zero. Your brand will still have a value even if your enterprise value is zero. So what happens really is the share price can be affected with any short-term news, positive or negative. The brand value is a lot more stable element to track or to monitor, because that really says what it's an asset, and you should treat it like one. This is just an example of Google on 31st of October. Now, if you look at this enterprise value of Google, and the tangible assets are very, very tiny. They're just 49 million and 350 million, the intangible assets. Within that, the disclosed ones are only 17 million. So there are 332 million of undisclosed intangibles. Now, of course, some of the larger companies track some of these at an investor relation level, or because they have to use these in the annual reports, or they have to make formal disclosures about these, sometimes with regulators, etc. But majority of the companies may not necessarily be looking at some of these in as granular a detail as they should be looking at it. Now, here, if you look at it on the next chart, is you have contracts, you have customer, you have technology, and you have marketing intangibles, which are 105. 109 million is the value of the brand alone out of the total 350 million of the intangible value that there is. So almost 30% of that is the brand value of the total value of the intangible. And if you look at the tangible to intangible ratio, again, there's almost 80% of intangible and just about 20% of the tangible. So that just gives you a sense of how important the brand should be to the business and what is at risk if it's not managed correctly. In this case, the risk is 109 million US dollars is at risk if the brand is not managed properly. Move over to a few months later, 6th of February 2017. So just about October to Feb, about 5 months later, the enterprise value increased to 415. So if you look at it, the increase in the enterprise value is only $15 million. But look at the brand value increase, 109 becoming 121. There's a much higher increase in the value of the brand. So if you're just using an enterprise value or your share price as a way of benchmarking your brand value increase or decrease, that may not be entirely correct. And it may not give you an accurate picture. Sometimes it may not give you a correct picture at all. There have been instances, and I can quote a case of HSBC, because they used to track it very regularly, is the enterprise value in a certain year went up by 35% and the brand value went down by 17%. And that kind of thing can be fairly common because both are done at a point in time, and depending on what that point in time is, you may get a very inverse relationship or not necessarily aligned outcome between the two. So keep in mind, don't just keep tracking enterprise value thinking this is a good benchmark for brand value. Brand value must be tracked separately because it is an asset within the business, and it has a stronger implication on the long-term performance and the success of the business. Now, when we look at the brand value to enterprise value ratios, that's also a good benchmark for you to start to follow, to say how much of my enterprise value comprises the brand value. There are different benchmarks for different sectors, and I will just share some with you. These are watches, for example, 35%, luxury goods 40%, 43% average for luxury cars. What does it mean? On just one glance, it will tell you the more premium the brand, the higher the percentage, the higher the intangible value, the higher the brand value. Yes, that's correct. But the higher the number, the higher this percentage of brand value to enterprise value also indicates that if the number is higher, that means your brand is driving your business success. The number is really, really low, that means your business is driving your brand. There's very little that the brand is doing for your business. I mean, take mining, for example. If it's, let's say, 2%, 3%, 4%, and someone comes and acquires that business. So let's say I go and buy that business. That is a enterprise value, brand value of, let's say, 2 or 3%. If I rename it, not a great deal of loss is going to take place. But if it is 45 or 50 or 55%, if I rebrand that business, or if I change the way the brand is managed or not managed, that's going to have a huge implication on the business performance and the business outcome. So the higher the percentage, you also have to worry about some of the frequent changes that are being made to the brand at the same time. So you should not be really frequently driving a positioning change, for example, or when you acquire someone, then you need to know if you acquire a brand that is a very high percentage, you should not just quickly rebrand it to yours, because you're going to lose a lot of business value, market value, and revenue, etc. So these are all very good benchmarks that can you use for acquisition, for your brand architecture, when you're actually launching some of the strategic initiatives, marketing campaigns. We can also calculate what's the likely increase or decrease that any of your activities and initiatives is going to bring to the overall percentages. All right, coming back to the top 100 brands in Malaysia, the total value is 49.3 billion USD. A drop of 11.8%. Is that a bad thing? Not necessarily. We are in the middle of COVID crisis. Actually, not really sure if it's the middle as yet, or we are at the end of it, or we still just sort of scratching the surface, because nobody knows how long this will continue. But having said that, a large part of that is because of sudden drop in revenues over the last financial year. So the baselines for most brands have reduced somewhat. But having said that, since a large part of that is also based on the future revenue forecasts and future projections, those aren't really all that shaken up. Contrary to popular belief otherwise amongst the masses, the investor community still remains very positive about the performance of the businesses. We haven't seen any stock market crashes in a big way or even in a smaller way overall, except for Bitcoin for a short while, for those who invested in it. But so this drop is okay. It's within an acceptable range. I would say it's not something that you might start to lose sleep over from tomorrow. There's a reason for it, and that's because of some of the market conditions that are there. I pay a lot of attention to this slide in particular, and the reason for that is very simple. It tells me what's happening at the top and what's happening at the bottom. The top 10 is 63% of the value contributors. So out of the total value of 49 billion, 30 billion is actually coming from the top 10 brands. And that's where the problem lies. If you look at the bottom 10, 51 to 100, only 7% is the value contribution of the brand at the bottom 10. And that's really small. 41 to 50 are contributing 4%. So it just goes down very rapidly as you go around the circle. Is 63%, for the next 10 is 15%, for the next 10 is 8%, next 10 is 5 and 4, and then for the whole of the next 50 is 7%. A lot of times they're also asked to say, why don't you publish the top 200? Because everyone likes to see their name on the ranking. But guess what? It's a bit of a futile effort also. I mean, for 1%, 2% of the total value, the quantum of work that goes into it is enormous. And that may not necessarily be very useful for the companies that have a value of, $500,000 or a few $100,000. It may not necessarily be very beneficial for them. By sector breakdown, oil and gas, 25%, no surprises there. This is largely courtesy Petronas and some of the other oil and gas players. Banks come second, 21%. Singapore banks are number one actually, so they play the role of the top three brands in Singapore, then followed by telecom, then leisure and tourism, utilities, etc. Healthcare, retail, commercial, hotels, and these high intangible sectors. I mean, hotel is a high intangible sector. Your real estate can also be high intangible sector. Your food is reasonably high intangible sector. But the fact that they're actually going down the curve just shows that there isn't either a great deal of brands present or there isn't a great deal of focus on brand building in some of these areas. Oil and gas, on the other hand, I think our congratulations to Petronas. They do a fantastic job in brand building. They manage it way beyond the normal brand management practice and expectation. So usually, I mean, it's a commodity at the end of the day, and the percentages are usually very small. I mean, leave alone the brand value percentages, the overall value can be high, but the percentage of BV2, which you will see later, should be really small. It isn't. They actually perform very well. I mentioned the rating, the AAA, AA, all the way to D. So 80 to 100 is AAA. So AAA minus, then AAA, then AAA plus. That's how it goes. So if your scores are, if you have a AA, you can roughly say my score will be between 65 and 80, which is a strong brand still. But if you are A or below, you should be very worried. Because then your brand needs to be strengthened and your brand needs to have more focus, or you need to manage it better. The AA rating by sector here, your banks are the highest, then telecom, then so automobile, insurance, etc. AAA also, telecom and banks are the ones that are very high on AAA ratings. Banks, by and large, because they have higher equity, higher engagement, higher everything, and there are lots and lots of them in most markets. Given the current conditions, the market conditions, I think financial products are doing very well in an overall scheme of things, whether digitally or otherwise. So that's what driving their brand strength ratings. Having said that, it is very important. If you look at it from 2020 to 21, where the increase is, the AAA rating brands have increased. The AAA minus have decreased, but the AAA have increased. So the brands at the top or across are getting stronger, are getting in a better position. So A reducing and an A plus increasing. So brands are getting more competitive. And it's important for you to understand where you stand vis-a-vis some of your competitors, how far ahead you are from them. So if you have a score of 80 and a competitor has a score of 60, less for you to worry about, or you can see which areas you're way ahead of them and which areas you're almost neck to neck. But if your competitor is at 68 and you're at 70, you got to really be on top of your scores. What is driving your brand equity? What is driving your brand strength? What is driving your brand value? You really got to be on top of that, because otherwise there'll be a very sudden drop next year for reasons unknown to you, and by then it might be too late. Number one brand, Petronas. Like I said, no surprises. And I don't think anyone is in a position to dethrone them for a while, because the gap is just too wide. Same for DBS in Singapore. Petronas is also one of the only Malaysian brands in the global 500 rankings, if I can say so. Banking 500 has all the banks in the global 500, but in the oil and gas, Petronas is the number one and scores very high across most of the global rankings and the sector rankings overall. 12 billion is the value, down from 15-20% decrease. But that's, again, like I said, not so much to worry about or lose sleep over. These are all numbers that should get corrected in about a year's time. Maybank, 8% decrease on the value over last year. 3.6 billion is the value, down from 3.9. So number one remains number one, number two remains number two, and as I was saying, no real risk to Petronas losing the number one position because the gap is so wide. But having said that, they still have to constantly try harder, because they're not even competing within Malaysia. Their competition is at a global level. How are some of the other oil and gas brands performing? So they are more operating at as a global oil corporation at a global level. They have to compete with the Shells and BPs of the world and Exxons of the world. They also have to compete in a global 500 across all the other brands, and not just within the brands in the country. Genting, number three, 10% decrease in value. Number four, Tenaga, very marginal decrease, only 4%, 2.6 billion is the value of the brand. So as you see, between second, third, and fourth, sort of the gaps are narrowing. So the chances of moving up or down are much higher. And that's where the brands also have to be very careful. If number two or number three or number four position is dear to you, then you need to keep a very close track of what's happening on an overall market level, at an overall brand value level, etc., and where some of your vulnerabilities are versus some of the other brands. Sam Darby, 2 billion, 15% drop from 2.4. Public Bank 6, CIMB 7, Maxis is number 8, number 9 is AirAsia, and number 10 is DG. Strangely enough, if you look at all these 10 brands, they've all maintained their position, because almost everyone has been affected by COVID crisis one way or the other. So all of them have lost value. So again, no shame in going back to your management to say, I've lost value. You can show them this chart and say, look, it's not just us. The whole market is in a similar position. So nothing to lose sleep over. What you need to really look at is how strong or weak your brand is, because if you're losing brand strength scores, then that's the sign for worry. That means those who have maintained the brand strength scores and those who have improved it despite the crisis have a stronger ability to recover once some of the crisis elements tend to disappear. So I think focus as much on the brand strength index. Don't just feel good about being number 1, 2, or 6, or 10. If your brand strength is reducing, you should worry just the same. Strongest brand. Now I'm going to get into some specific mentions. So strongest brand by brand strength index is Digi with a AAA rating score of 87.3. So that's the strongest brand in Malaysia at the moment. If anyone has joined from Digi, our heartiest congratulations to you. The most improved brand in terms of value increase is Hong Leong Financial Group, $107 million increase. Contrary to some of the other banks that have actually lost value, they've had a very decent increase. Most improved brand by brand strength. So the score, highest improvement of score is 57 to 63. So they become from A to A plus, and that's a good jump. So again, if your brand strength ratings even goes from 60 to 62 or 62 to 63, don't think that's a small number. That 1 or 2 point difference can actually have a big impact on the value also. It can have a few $1 million, a few $100 million, depending on what your value is. So it's not an easy number to achieve, to say, oh, I want to go from 60 to 65, so that's an easy number to achieve. Not necessarily. You may still have to manage a lot of things better or in a different way to be able to achieve that number. Highest intangible value, 61%, Padini Group, and they've been growing very well over the years and holding that high intangible value percentage. That basically means the brand is driving the business extremely successfully. So as I said earlier, the higher the percentage means the brand is driving the business, the lower the percentage means the business is driving the brand. So in their case, if you change the name Padini to something else, they will suffer significant business losses if you were to look at this number as a business driver. Highest ranking growth, well, no surprises here. Top Glove, they were ranked 37 in 2020, grown 10 places, very strong forecast. Of course, there have been some ups and downs in the news, but overall, the forecast would remain strong for the near future. How can we help as an organization? Well, you can have your brand trophy for your ranking. You can have your certificate from the ranking. If you would want any sponsored content from us, any video message or any PR support, we're happy to provide that. If you want to do an event of your own, we're happy to then come and assist with that as well. Or if you want any digital infographics for all these rankings and values, do drop us an email and we'll be more than happy to help on any of these areas. What do you do with this? When you have the brand value and the rankings, it's treated like an insight, treated like what is driving my performance, what is driving my KPI, what is driving my comparison with others. And if you look at it like that, you'll probably start to look at it from a very different point of view, as against, this is not an award that you're getting. This is, so don't look at it like an award that once a year pat on your back. This is something that is much more than that. It can help you drive your future strategy better. It can help you benchmark. It also drives deeper education internally, and all that comes with the brand value rankings and the brand value reports. It allows you to just better understand how the brand is contributing to the business, and that's a big advantage for people who can hold that argument with the CFOs or with the management to say how the brand is supporting the business, versus those who cannot hold that argument. The management will have a very different view about how much they want to spend in brand, how much do they want to cut when the fourth quarter comes and the budget cuts happening. You can actually defend a lot of your budget cuts if you understand what that investment is bringing in return. Back to how you can get more details about your ranking and value. If you're not in the top 10, our website is going to have a locked version of it. So you will either have to register on the website, but for a very short period, you can actually go to the Invest website, scan the QR code, or if you forget the QR code or unable to scan it now, just go to the website and you can register and download. So that's all on the ranking part overall. As I said, I have a two very interesting gentlemen with me, John and Robin, and it's time to sort of start to grill them. Brand or business, what does it mean? Which is the right one? Which is the wrong one? I just have a few more context setting to that. Take Petronas, for example. Number one, so we have to show it. This is their ranking. They got 87 out of 100 as a score for brand strength rating. AAA, extremely strong brand, is the strongest oil and gas brand in the world. And they want to remain in the top 3 or the top 5 on an ongoing basis globally, not just in Malaysia. So that's really the way you should be setting your KPIs. Don't worry about the drop. Like I said, that's true for everyone. What is more interesting in brand or business is when you come to what are the key contributing factors to the value increase or decrease. It can be increased or decreased by largely 3 broad factors. One is the brand itself, the other is the performance of a business, and the third is the external factors. Now, external factors you have very little or no control over. It could be changes in the tax regime, regulations, what you can and cannot do, or various things that are all externally dependent. Those impact everyone within the country and within the certain sector or the businesses. You have very little no control on them. In fact, COVID is an external factor. You have very little no control on it. Then comes the business performance, which sometimes is in your control and sometimes it isn't necessarily. So COVID has also had an impact on the business performance for everyone, and that's a factor they don't control. Now, when it comes to the brand, it is our belief, and we stand by that. That's one aspect where you always have 100% control. How you want to build your brand, what you want it to be, that's where your control is the highest. And that is where you should ideally not look at a red gap, a red box in terms of, oh, the brand has been the reason why the value has decreased. It could be a flat line, it could be 0, it could be 1, but it should ideally be a positive number. So in case of Petronas, the majority of the reduction is actually the business performance factors and external factors. And brand has still contributed very large, $205 million has been contributed by brand because the brand has remained stronger. So when you start to look at this brand versus business, it's a good way to look at some of that information and analysis. I'm just going to quickly run through some of the other brands. Tenaga, again, a AAA brand, reasonably strong, not as big a drop in the value, reasonably just about a little bit of dip there. Look at the brand contribution. It's $447 million is the contribution of the brand. The majority of that decrease has actually come from external factors and the business performance factors, which again, they don't really necessarily control all the time. The business performance, one might argue that everyone's working from home, so the consumption of their products and services would have increased at a home level, but because of the lockdowns, the consumption in offices would have gone drastically down. So again, you don't control some of those. Some of the factories would have been producing reasonably lesser. Some of the factories will be producing more. So those are some of the variables. But that's the key number. If someone were to ask them, what's your ROI for the brand for last year? We gave you $5 million to spend. What did you get us back in return? Tenaga can actually stand up and say, I gave you $447 million in return, contributing to the value of the brand. So start using that as a number. Start putting that KPI for yourself as well as for the management if you can. The brand strength index and brand value contribution are two very good tangible KPIs that you can actually demonstrate, find the reasons for why the increase or decrease is happening, and they actually help you do a lot more from a strategical point of view rather than not. I'm going to look a few examples where it has gone down. So again, if you see here, the values remain reasonably stable for Maxus. Brand is strong, 84, AAA minus. Guess what? The business performance has contributed, is the external factor in the brand that has a negative contribution overall to the value. So any increase that they got from the business performance has sort of been negated by the reduction in brand strength and external factors. Had there been two more positive contributors, the brand value would have been a lot more. So in real terms, when you see the drop is really, really little, but when we look at it from an external point of view, and if you're saying, look, has the brand effectively contributed to it? The short answer is no. So why would the business performance only go up? It could also be because sometimes you're running a lot of promotions and offers, or sometimes the market is just naturally buoyant towards some of the business needs. Again, in the current era of lockdowns, people perhaps are more dependent on the devices, on the telecom, internet, and a whole lot of other things. So that would have increased the user in consumption, but the increase on the brand value would not have necessarily come from the brand itself or the improvement in brand strength. So you need to keep a check on these. Just because your value is increasing doesn't mean you should feel good about saying, oh, everything is all right and I don't need to do anything. Last but not the least, AirAsia, hugely impacted industry by because of the COVID. Planes are grounded, everything is happening all around. Well, but again, if you look at the business performance and external, not as big a block there, just 20 and 65 million, but the majority of the reduction of the value is actually coming from the brand strength being weakened over the years, over the past 1 year. So again, if you look at it from what's contributing and what's not contributing, your whole perspective of the value increase or decrease will change, how you manage the brand will change, and how you manage some of the brand strength will change. Two quick case studies before I get John and Robin to join us for the discussion. Lotus and Geely, your own homegrown brand from Malaysia, was sold to Geely Motors, 80% stake for 51 million pounds and $87 million. Now, what it did, sometimes a successful brand is acquired or can do wonders to another brand. And when you're looking at some of these acquisitions, you also need to keep that in mind. When someone is out to buy you, what are they trying to achieve? They're not just buying you, they're also buying a lot of intangible value that they're going to benefit from once they acquire you. And that's what happened in this case. Geely moved everything to China, Lotus goes to China, and that actually had a 2.3 billion brand value increase for Geely by just that acquisition alone. So had someone in Lotus kept that in mind to say, look, hold on, what is the value that Geely will get by way of acquiring us, they would have probably structured the deal very differently, or they would have said, hold on, you can buy everything from us, but guess what? We're not going to sell you the brand as a whole. Or they could have retained the brand for a lot of other areas of application and only given the license to use the Geely Lotus brand for automobiles, for the car manufacturing. But everything was sold lock, stock, and barrel. Huge increase for Geely, and probably not such a good outcome for Lotus. Of course, they were able to sell the stake, but who benefited more and who benefited less from it is something that can be evaluated. BMW and Rolls-Royce, and that's a very interesting example. So the Volkswagen, there's a consortium, Vickers PLC, they paid 780 million for the Rolls-Royce motor cars, and they bought the brand and they bought the company. What they thought they were buying everything as one wasn't true. They were actually only buying the tangible assets and some of the other aspects, but they did not realize, and this is a case of perhaps having more attention and focus to due diligence when you're driving an acquisition, is that the brand Rolls-Royce was actually not kept with the automobile company. It was kept with the aviation entity, which used to make the engines. And BMW was much closely aligned to Rolls-Royce, the aviation company, than Volkswagen was with the car companies. Well, the bottom line is $780 million was paid without the brand. And as a result, Volkswagen could not use or launch a Rolls-Royce car unless the brand rights were given to them. BMW went ahead and bought the brand, just the name and the Rolls-Royce emblem and the Spirit of Ecstasy emblem that sits at the bonnet of it, for $65 million. So $780 million paid by one company and $65 million paid by the other just to use the brand. And after that, BMW said, look, I understand that you guys have bought the company, but guess what? You cannot launch a single Rolls-Royce because you don't own the name. So any of those who think what's in a name, there's a lot in the name. You can sell it separately. You can give the license. You can write for the company, but you don't have to sell everything lock, stock, and barrel. There comes the advantage of the example of Mr. Jimmy Choo, who again is a Malaysian and a very successful one. Absolutely iconic brand in the fashion industry. But when he sold his stake in the company, everything was sold lock, stock, and barrel, and he could not even launch anything else afterwards in his own name because the brand was sold with everything else that he had. So his whole stake of 50% was sold for 10 million. Guess what happened afterwards? He actually tried to buy back his company through a consortium just 15 years later for $500 million. So something that is sold for 10 million, he tried to buy back for $500 million just a few years later. So that's how the brand is treated, or how brand is looked at. If you may end up losing a lot of value. Banyan Tree Resorts, again, residual value came out to be a few $100 million more than the actual value, which basically looked at the extension possibilities of the brand. And that's where some of the things really can become very, very different if you know what to look for and how do you drive the brand growth, how do you drive the brand acquisitions when you're acquiring or when you're divesting. So if you want your IP to be an asset, I would always say treat it like an asset, not just treat it like something that's there and getting managed by itself. Measure it at least once a year. Our rankings is a good measure for it. Manage it both internally and externally. We always say internal brand management is just as critical or sometimes more critical than external brand management, because if your people get it wrong, you will be building the brand in a very different way, which may not be very beneficial for the organization. Maximize it through your different strategies and products, everything aligned to the brand, and monitor it on an ongoing basis. If you're doing all those four, you'll have a very good outcome. Now, over to John and Robin for some insights. Can I ask the two of you to switch on your cameras?
You can ask Samir, but unfortunately the camera isn't starting for some reason. I'm not quite sure why.
All right.
You need to allow
Bernard can help with that.
All right, let me see what I can do at my end. Otherwise, Bernard will do the troubleshooting from his end. All right, let's see if I can make you the host, and if that helps you. I'm not sure if I can do it for both of you. All right. Well, sadly, I can do it only for one of you. My apologies. All right, we didn't have this problem during the other sessions. All right, while Bernard figures it out, we will continue. Sorry, we'll let Robin come on a little later, or maybe when John is kind enough to hand over the host rights to Robin, then we can see him.
Sure thing. Okay.
Just try and doing that, John, now. See, because when I've given it to you, I'm still visible, so probably it should work. If you right click on Robin and make him the host, the three tiny dots on the right side of Robin.
Yeah.
You just click on that and make him the host and see what happens. Hopefully we should be able to see him.
It's not happening. I got 3 dots, live Facebook, work, Facebook live on YouTube.
Make host.
I'm sorry, there isn't on my screen, there isn't something like that.
All right. Not a problem. We'll see how we manage that. Perhaps Bernard will be able to. But in the meantime, all right, let's start with Robin. Since we don't see you, we'll give you the first question. So, do you think the corporate leaders see any benefit in strong brands, or do they just manage businesses and they think they're managing the brand?
Yeah, that's a really good question. I mean, first of all, congratulations to those brands that you just referenced in the top 100 and the top 10. I was looking at the guest list. There's a few old friends on the guest list, so I can't see you, can't see me, but it's really nice to be in the company of some old friends. In terms of the question over organizations, I think it varies. We have the sort of the privilege, I guess, in our business working with many brands. Being an advertising and marketing services company, and we work with businesses that really understand the power of the intangible value and what that can bring as a gravity, drawing consumers to them. An example of a brand that really understands the power of and the value of the brand is Singapore Airlines. So they have long created an identity and a concept, and consistently delivered that in a way that has enabled them to I guess withstand certain headwinds and to charge a premium. There are other organizations where I think the C-suite kind of equates or conflates brand with advertising. And kind of sees it as a job to be done over there, and whether that's a corp comms job or a marketing communications job, brand is kind of a consequence of successful business, but it's not a cause or a driver of business. And I think that's a mistake. Clearly, many of us in this business would think so. One thing I say to those organizations, and I made a presentation to a CEO of a global bank some years ago, about the defensive nature of a strong brand. So a strong brand can build obviously into a balance sheet all that goodwill, and that can create a wall which makes hostile takeovers a little bit more difficult. And actually getting an organizational leader to realize that the brand isn't just a sales tool, but is actually an organizational defense. And gives a company greater control over its destiny, I think was something that was a surprising narrative. I don't think that CEO had actually thought about it that way before. And consequently, there was a reinvestment in the brand, both in terms of presenting the brand, creating coherent strategies for the brand, and creating an identity system that enabled people to recognize the brand through certain characteristics and cues in a more, I guess, condensed and simple way.
All right, that's very useful and helpful. Can I just ask, do you people during your discussions, during your engagements, specifically try to distinguish between brand and business in any way?
Me? One of the things we talk about is it's really important to look at a brand as a set of experiences. I mean, a definition I was given many years ago was a brand as a set of emotional memories. And those memories come from every touch point. They come from hardware, they come from software, they come from communications, they come from word of mouth and every other touch point. The more coherent that story can be and that set of memories are constructed, the greater the opportunity for the brand to grow in strength. So I don't think it should ever be a binary thing that brand and business are kind of different and distinct. They're merely different instruments in a greater whole. So one of the things that we speak to clients a lot about as well is to lift a viewpoint from Byron Sharp, and that is about physical availability and mental availability. And I don't know how familiar many of the people on the call are, but the principle behind that is that people tend to be relatively miserly when it comes to remembering corporations and businesses. They've got many better things to be thinking about. What they want to eat, their favorite music, their favorite artists, movies, and so forth. So they don't go around with brands top of mind. So brands that have a lot of physical availability, and Petronas is a good example with many forecourts all over the nation, will tend to dominate the memory structures of the brand. And typically when the category communicates, most consumers will attribute certain characteristics to the most physically available brand, and it kind of sucks up all the goodness. Thereby, challenger brands and brands that are seeking to steal some of that share and grow into a sort of more leadership role need to kind of work out how can they avail themselves of, or can they generate greater mental availability. And that is the role of experience design, that's the role of product, that's the role of distribution, and the role of marketing communications, to knit together a way for people to recognize distinctive cues, relevant cues, and ultimately cues that drive some form of attention and hence consideration. So I think one of the things that we find really important in our world, and the Singapore Airlines example was a perfect case of that. They created cues with the batik, they created cues with the Singapore girl, they created cues with a very distinctly created set of cabin experiences, both in first, business, and indeed economy. By knitting that together, would you say Singapore Airlines is a great brand because of its advertising, or because of the experience, or because of the kind of the mystique and the legend that they've kind of created in their various assets? And I'd argue it's all of these things coming together that works, and you shouldn't, and no organization should be looking to break these things apart and go, it's only this or it's only that.
All right, question to John now. In your role as the president of IAA, have you seen again how the companies or the corporates approach the brand versus the business? Because again, IAA is about International Advertising Association, which primarily would be again more driven from the communication side. Is there an engagement where you see that the brands are seen to be less important than the business?
Yeah, I mean, firstly, when you had, can you hear me?
Yeah, loud and clear.
So when you had a subject like brand versus business, they kind of felt like it's mutually exclusive, but it's not. They're not mutually exclusive in value creation. I think you would agree, right? And firstly, I personally believe a brand without a business to manage the customer experience journey delivery has limited value. If it has right now, it may not be for long. At the same time, a business without a brand has no soul, has no essence to be able to protect that value. So they're not mutually exclusive, right? So, and if you ask me for an example, and further, I think the brand is a way your business is perceived, all right? And that's in its very simplest terms. And the business is the way your brand is consumed or experienced by the user, right? Because all the infrastructure around the businesses makes that experience possible that the brand has promised. So they're not mutually exclusive. Now, when you ask me of an example, I'll take the example of a brand that I've been associated with for many years, is the Coca-Cola company, right? And Coca-Cola as a brand, its role is as the beacon of positivity and uplift. Right? I'm sure there's other words to describe it of late, but for me, it still stands the beacon of positivity and beacon of upliftment. Right? But the business role is to have the right product in the right place, in the right package, at the right temperature, at the right price, within the arm's reach of thirst or refreshment. So you can see why the brand is extremely important. It is what potentially what the valuation of the brand is much higher than the tangibles, if you want to call it that. But what keeps the brand so strong is the fact that the delivery mechanisms against right product, right price, right package, right temperature, right place works well to fulfill the promise of the brand of positivity and uplift. So I think they work hand in hand.
Interesting. I have a related question, and that is, yes, they work hand in hand, and I think that's the view mostly from an external point of view for the people who are looking at from outside, which, okay, everything is working hand in hand. But in your experience, let's just look at a marketing department having 100 people, and one could argue that they're also doing the brand building. But when you talk about a brand team, specifically a brand team, there might be just 2 or 3 or 5 people sitting in one corner of the room. Does that really reflect the same picture that we're all talking about? First to John and then to Robin.
Right. I mean, you seem to have assumed that the custodianship of a brand is with marketing.
Well, that's how companies look at it. That's why they are very
and they shouldn't. All right. And I think some of the experience you've shown, some of the results you've shown show that too. The custodianship and leadership of a brand doesn't belong with one function, because brand is primarily in that strategic space. It sits at the C-suite, at the board level, and with every other level within the company to understand and live the brand and its values, right? So if a marketing department has a brand function with 2 or 3 people, I mean, I don't think that's indicative of the companies, the way they look at branding, because branding is not just about branding cues and elements. It's much bigger than that. It's got to be entrenched throughout the organization and how they think. Now, I go back to a question you asked me earlier, and one of the results you showed is Top Glove. That's an interesting one. And because you went through so quickly, I can't remember what the brand to business valuation metrics were. But here's an organization, from my perspective, has been very focused on the business. In fact, I personally don't fully understand their brand strapline or tagline or whatever you want to call it, top quality, top efficiency, I think it is, right? But be that as it may, all you hear about this brand is all about all I've heard, and maybe I missed out on stuff about working conditions, welfare of staff, yada, 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 all the negative news. The brand seems to have focused all its attention on the business, but the brand trust initiatives are silent.
Yeah.
And I would have a big question why, when it's a high valuation brand. I think the market cap is in excess of, help me out, 30 billion ringgit or something. And the share price has probably doubled or trebled to 8 or 4 ringgit per share. Do they recognize the need to build brand resilience for loyalty and stakeholder trust? I mean, they do talk about it, but I don't think there is in practice. So I don't know what the marketing department or the brand department of Top Glove is, but there is an example of where there's a significant opportunity for the brand to talk about what it stands for and what it is, and that could help drive the valuation of that business much more.
Of course, of course. Interesting that you mentioned Top Glove, because yes, they're primarily focused on business because of the circumstances, and I think they've sort of perhaps gone reasonably far ahead because of the current situation. So, and if they do not put enough resources in the brand building during these times, I think once the crisis is over, their success might also just go down in a disproportionate manner. Robin, over to you. What do you think about the imbalance of people in the marketing teams and the people in the brand teams?
Yeah, I mean, there's a couple of points that come to my mind. I mean, the first one is who actually owns the brand. And to reference one of John's clients, the legend of Coca-Cola and New Coke is infamous for asking that question, right? So, I mean, Coca-Cola thought they owned their brand and they could do what they liked with it. The consumers in America felt otherwise, you know, sort of protested a new flavor of Coke the way today's generations protest wearing masks or going to war. It was quite an incredible time. So I think, again, it brings us back to that question of what is a brand? And a brand is something that people feel a very strong, or a strong brand is something that its audiences have a very strong relationship with. And in a world of social media and so many touch points, I think the control of a brand is increasingly complex. I think one of the things that brand owners need to do is really understand the currents of culture and how a brand sits in those currents, and so they can help steer and guide. But I don't think the total ownership anymore is as it once was. Now, coming back to your earlier point, Samir, I think the other thing that kind of is interesting is some organizations have, I guess, what we call a corporate brand. And that is a very specific piece of campaigning around telling the world what kind of company a business is. And that might well sit in a small group of corporate affairs and a small group of marketing people. But in more enlightened organizations, the brand is a responsibility. And in a lot of major multinationals these days, there are chief brand officers, and their role is to network and integrate all the different sort of facets that impact the relationship a business has with its audiences. I mean, we started working with Philips recently, and that's a fascinating business because Philips used to make light bulbs, they used to make toasters and TVs and hi-fis. Now they are a medical equipment business. Their actual business is in med tech, right? Personal, networked, and professional. But the Philips brand still exists, making toasters and irons and deep fryers and other stuff. But they've sold that business, but they manage the brand. So that's kind of slightly sort of similar, but different sort of Rolls-Royce, BMW example. They actually recognize the power of the Philips name, and the more places this brand can exist in people's physical space, the stronger that brand association becomes. Yeah. But it absolutely has to be managed, right? So it has to be managed not only within a company, but actually a whole bunch of venture companies or venture capital driven companies who are making these appliances. But the Philips-ness, the things that stands for, the innovation pedigree, the quality pedigree, the design pedigree that defines, and the sense of adding value to lives, that has to come through all the way. So that is a brand that is owned from the center, executed by a whole host of different businesses, and yet is very coherent. And so if a brand can be managed across different companies, surely it can be managed within a company. And so whether it be in R&D and people looking for where the new innovations are coming from, if it's in pricing and distributions, looking at where are the inflection points for where value is deemed to be a positive versus suddenly you're losing value because you crossed the threshold of quality over price. Yep. Looking at the community that a brand supports and builds relationships with, as well as the key customer franchise, and who are the loyalists and who are the trialists, and making sure that, and I say that can't be three people in a marketing department. That has to be something to be successful that runs across the gamut of a business.
All right. There are a few questions that have been asked live. While I answer that, can I make a small request to John? Can I just request you to exit and enter again, and let's see then what happens.
You want me to sign out, huh?
If that's all right with you.
I'm okay to sign out. So I'll just end and sign back in. Okay.
Yes, that would be wonderful. All right. So there's an interesting question here to say, what is the percentage of drop that will is seen as dangerous for the brand value decrease over the years? Well, there isn't any right or wrong answer for it. I think it depends on a variety of factors. What's causing the drop is the first factor. And like I said, there have been a host of external elements that can actually lead to a drop in value. As you saw, the top 10 have all dropped, some with 4%, some with 20%. So there is nothing alarming about it because it's driven due to uncontrollable external circumstances. Now, if you have a continuous drop on an ongoing basis, and then that's the sign to worry. Every year dropping 10%, 15%, that's a sign to worry. If you have a drop for more than 3 years in a row, you should be very worried and saying, what's causing it? What am I doing wrong? What is that's not working? So hope that answers the question for Jane. A quick question from Mr. Ahmed is, it's an IR related question. And he says, that brand value is independent of stock value, and what would be a good approach to communicate the brand value? If you pick up the, I think the easiest way to communicate that is put it in your investor relation presentations. I think the dashboard that I just shared, a lot of companies use that in the investor relation presentation, comparing the brand value with others. If you pick up the annual reports for most of the big brands, you will see that they actually mention the brand value within the annual reports. It can't be included in your financials, but there is always a brand section within the annual report where they actually mention the ranking and the value and how well they're doing on that. So there are different ways to take this to the investors. And if you know the percentage of tangible to intangible for your sector, then that's again a very good way to benchmark yourself against that and then say, look, I'm doing so much better compared to the overall average of the industry and sector, and that should work very well in an overall scheme of things. All right, I think we still haven't managed to solve the video problem for Robin and John.
Can I just add a point on what you're saying just now?
Yes,
that's a really important point. I think the point you were making about the intangible value being such an important lever for businesses is something that I think we all need to kind of reinforce across the various sort of, I guess, decision makers in organizations. I mean, ultimately, the brand is the thing the customer is connected with, right? And that doesn't matter if it's a B2C, a consumer world, or even in the B2B space. There was a famous campaign slogan, I think back in the 80s for IBM, said you'll never get fired for buying an IBM. And that gave the reassurance that that even though it may be a bit more expensive, it would always work. And that sense of confidence and that sense of trust, that implicit sense of it's safe for your company, therefore it's good for your job and your career, was such a powerful, simple missive about not risking it in that sort of space. And that's a brand play, right? That's a brand play that's talking about how the emotional consequence of making a choice sort of pays off. And I think that's something that that gets forgotten about a little bit these days, that it's not just a consumer thing, it's not just a trivial thing. These are fundamental in the decision metrics that people make when they buy. And if they're buying a B2B thing, I mean, we talked about Top Glove earlier, right? If you're buying an IBM in those days, a PABX or a big computer system, those are multi-million-dollar contracts. And yet the decision by the key decision makers has been driven by an emotional understanding of the fear or the anxiety and the ambitions they have for their careers. And I think that's where the intangibles come into play. If you can build that intangible value where you believe that making that brand choice will never leave you high and dry, then that's an incredibly powerful thing to leave people. And I think that applies in every category. Whether it be a high consideration, high risk category like automotive or buying jet planes or real estate, or whether it be in relatively low risk, less involved categories like buying a soft drink. That emotional consequence of the decision you make is, I think, where the brand has a really important role to play.
Great. I'm going to run a few surveys also, and hopefully these are interesting questions that we can get people to answer. And so I'm launching the first one about the KPIs, and would love to have your views as well in terms of what are the critical KPIs that let me ask John first. What are the critical KPIs, and probably in a very brief way that you have seen, just one or two? What are the brand KPIs that you see on a normal basis?
Yeah, I mean, can you hear me firstly? Yes.
Loud and clear.
Okay. So the KPIs I've been used to in organizations I've been, and once again, I'll refer to Coca-Cola because that is a company that puts a number against the brand and tracks it, right? So the Coca-Cola has always had a brand health measure tracking based on what is your favorite brand, what is your preferred brand.
All right.
And those numbers, about 70 or 80% is seen to be a right threshold level. Then it's compared against your market share for that same period to see if that favoritism and preference is translating to behavior or not.
All right.
And I think those sort of numbers are important. If we don't have that, boards and C-suite will be uncomfortable because they got nothing to hang on to, right? Okay. They need to have tracking.
All right, Robin, quickly, any KPIs, any unusual KPIs for the brand that you've come across?
Well, the most basic ones for brands which are maybe less established and less leadership than Coke would be simple things like awareness. There's no point having any brand metrics if people don't see you. The consideration metrics that kind of often come in behind that. Some brands do have associations to certain cues, right? So a brand like Standard Chartered wants to talk about recognizing the good and its sort of philanthropic characteristics when it's measuring its performance along with other things. So if a brand has specific things that matter to it, they also should appear there. Some brands will register for funds, some people will register for innovation, and whatever actually the key determinants of that company are.
All right. So now I have the poll results, and let me share them. Well, 56% people say yes to the brand KPIs, but at the same time, 44% people saying there are no brand KPIs at a management or board level. Just for clarity, we've asked the question, are they at a management and board level? Now, of course, there are a lot of KPIs within the operating functions and departments, but the management owning the brand or having KPIs for themselves at a board level are usually not only difficult, they're mostly unheard of, especially outside the larger organizations. So I think the examples that both of you gave are probably more at a product level. Clearly, management, senior management of the board will not get into the tracking of the brand or brand equity and this, that, and the other. Are there any KPIs that you know that the board has? I think just yes or no might be a good answer for now.
Yes.
All right. Robin.
Well, it depends. I think there are marketing-led companies where absolutely they do. But I think, again, one of the issues looking at the set of companies and you looked at the sort of from the top 15 down, I think in those organizations, they clearly don't. All
right. I have a quick poll question again, and then I'll keep running these in terms of does the management know the value of your brand? And the reason I ask this is when we go around talking to potential clients or our clients, it's very seldom that even the top management who, while the brand team might be using the value, the top management is not always on top of it. So that's why the question. In your experience, have you had any engagements with the companies where they have mentioned the value of the brand to you?
Is this a question to the general audience or to us?
No, to the two of you. Have you come across a discussion where the brand value is the point of discussion?
Not to any level of importance, no.
All right. Robin?
I have a couple of times. Let's say Singapore Airlines do talk to the value of their brand because it's one of the most important levers they have. I once talked to the CEO of a company about how his global head of marketing had lost him $2 billion. And a few months later, that person wasn't there. So it does occasionally come up, but it's not a conversation that happens very often. It's true.
All right. Well, our audience thinks 55% people say yes, the management knows the brand value, and 45% say no. Very heartening to see these results because we did the poll in Singapore and it was quite off the mark in terms of management knowing the brand value. So that's very good that in Malaysia, more than 55% people actually think or are saying that the management knows the value. I'll ask a quick question while I run another poll here, which is basically their pandemic impact. And let's see what people have to say to that while I ask the question. What's been the, have you seen a big difference in terms of brand management from large corporates to SMEs?
Who are you asking, Samir?
Sorry, you can go first, Robin, and then I'll ask John.
I think it's been challenging across the board for a lot of organizations to invest in, I guess, things that they might consider to be slightly longer burn when they're facing existential challenges. But at the same time, there are categories, and you showed some examples earlier of businesses that have actually grown their brand value this year. So I think some have actually seen opportunity, the likes of Grab, which is a brand we also work with in our Malaysian office. I think they've seen an opportunity to do more and build value in their brand because the utility of their brand has gone up. So I think it does vary depending on which business you're in.
All right. I'm going to end the poll, and we have some very interesting result here, which says, do you feel your brand has emerged stronger post-pandemic? And a lot of people saying cannot say, as we don't have any precise measures for it. Or, well, in Malaysia, as I was saying earlier, the pandemic may not necessarily be over as well. So it's but quite encouraging to say a decent number saying yes, and a lot of people saying no as well. All right. In terms of and
can just one thing, Samir, when they said that a lot of boards, majority of them do talk about the value of the brand. I just wonder whether they talk about the value of the brand or importance of branding. Because the boards that I sit, I've never heard about people talking about brand valuation, but there is some subscription to the brand is important and the importance of branding. That's all I want to say. Yeah.
Okay, while we've debated this a lot, I'm just going to do an audience poll on prioritizing the brand over business, and let's see what they have to say.
This is to the audience, huh?
Yes. You are allowed to participate, if I'm not wrong.
No, actually, I think we've not been allowed to vote this time, Samir. It's a big red warning at the bottom that says we can't vote.
All right.
So your fingers to be chopped off.
I guess so we can remove the bias from the survey. All right, I'm going to end the poll and then share the results. And well, here is the audience view. We prioritize brand over business. It's 26%, and 74% saying they prioritize business over everything else. So just leading on from here, what kind of imbalance do you think this causes in an overall scheme of things? And I'll first go to John. What kind of imbalance do you think this would be causing for the organizations? This kind of thinking where the business is seen more important than the brand?
I think perhaps if this actually is the case, perhaps it's driven by this unprecedented time of looking after the business, looking after the delivery systems, looking after things that need to be done versus specifically talking about the brand and investing in the brand, as somebody said earlier. It's a tough time to invest in the brand. I think it's a reflection of that. But having said that, I have difficulty with this question of brand versus business because it is not mutually exclusive, because on one hand, you're making a promise. On the other hand, you're delivering that promise in the right values, the right tone, the right manner. So they need to work hand in hand. But I think the results you saw earlier is indicative, I believe, of a unprecedented period we're going through, where investment in the brand is you have to prioritize the dynamics of the business versus investing in the brand. Right?
Okay. There's a question here which says, what's the impact on a brand in terms of valuation and strength when it embraces ESG actively compared to a brand that does not embrace ESG? And I think the ESG is something that's been growing over the years. Some of it is mandated by some of the listing requirements, just the same. So very quickly to answer that, that's from Edward. Just to answer that quickly, yes, ESG does improve the strength of the brand. ESG does provide a certain benefits, and with the brand strength increase, as I was explaining earlier, your value would be increasing or decreasing depending on which way the brand strength is moving up or down. So yes, there is a definite impact. Can be measured in absolute dollar terms. Yes, it can be measured in absolute dollar terms, just the same. To say if an ESG score is increasing, what is that increase bringing to you in terms of, is it 3 million, is it 5 million, is it 100 million, or vice versa? So it's all possible, and there is a definite upside on actively embracing ESG versus not actively embracing ESG. So I hope that answers that. I did ask a question about the size. Does the size matter? Do bigger companies have a better grip on the brand, or do they manage it better? Let's ask the audience, what do they think about it? I'm just going to leave the poll on for just a few more seconds. There's a question from Jane which says, what causes the overall drop for brand value? Like I explained earlier, there are three primary reasons that can cause the drop. It could be business, it could be external, it could be brand. And you need to understand which of these reasons is more relevant for you in terms of a brand value increase or decrease. Sometimes you expand the market, the brand value will get impacted. You grow your business within a certain vertical, the brand value get impacted in very different ways. So there's no easy answer, but those are the largely three boxes that actually increase or decrease the value. Let me share the poll. Do large corporations do better in brand building versus SMEs? The answer by majority of the people is yes. Some people say no, and others feel both do equally. Well, one thing is, of course, they have more money to spend, and that probably gives a perception to people that the large corporates do better for brand building. Not always something that we would actually believe in. In fact, it has very little to do with the money. It's got to do with what you're using that money for and how you're going about it. So again, I come back to Robin. In your example, from your point of view, can you give us a really good example where the brand impact was really, really tremendous with almost no cost?
I've got to think about that one a little bit.
That's a trick question. With almost no cost.
Yeah, I mean, I'll answer that in the way that comes to mind immediately, which is there's a lot of brands which have become very successful today, which didn't have a lot of money when they started, and they started quite recently. So one only has to look at the brands like a Grab, by way of example, from the Malaysian example, Airbnb globally. These were relatively small businesses. Yes, they had some venture capital, but a lot of their early marketing was done at pretty much a sort of the guerrilla level. Grab did a lot of stuff on the ground with taxi drivers in Malaysia and in other markets, and with commuters long before it did anything else. Airbnb was the same. It did a lot of stuff through community marketing and social marketing before it became threshold, or before it went beyond threshold and started to use more sort of paid media. So I think when looking at SME, there are different types of smaller business. There are businesses which have ambition to grow. They're in the right segment, and yes, they do have the capitalization to drive that growth. But they don't. But we're in a strange world where if you look at many of the strongest global brands, they weren't around a generation ago. These brands have kind of nowhere. And they're really strong. So I think there's actually a lot of examples where brands have really cut through. And it's not down to just advertising. I think that's one of the really important points to address what John also said earlier about the brand versus business thing. It's not about putting money into brand advertising versus product advertising. That's one facet of marketing, but it's not the main facet. The main facet is, I think, is creating a systemic view of what a customer's experience is and making sure that all the parts add up. And the question you had earlier about, whether it's short term, the long term, or business versus brand, I think if companies are doing lots of sporadic tactics, they won't get any benefit in the long term, because those tactics burn out and there's no residual value. I think where you do business activities, but they tap into and they grow in alignment with the brand ambition, the brand story, then you do have a value. And I think the businesses that we're talking about just now, like say, like the Grabs, the Gojeks from Indonesia, the Airbnbs from the States and so forth, they have had a very clear point of view. So even though they've been tactical at times, they are very clear what they stand for. And consequently, they've been able to drive a brand growth through a series of well-formulated, customer-centered activities.
All right. I'd asked the KPI question earlier. I'm just going to do a quick poll on the ROI measure. Just a quick question, John, on the side, while people are answering that, is in terms of an overall spend on the brand, what's a good percentage from your point of view, coming from IAA? Is there a recommended percentage for brand building? 3%, 1%, 5% of your total revenue or total marketing budget should go for brand?
I mean, we don't have a number as such, but if you look at a lot of businesses or brands that I've been associated with, from my recollection, from strong brand building, strong brands, anything up to 10% can go into branding. But it doesn't mean that that goes into advertising or into other. It goes into building a life for the brand. It goes into ensuring that what the brand stands for is fully entrenched throughout the organization and people live the values of the brand.
So the short answer,
that can be as much as that.
All right, so there is no real percentage, or we've not experienced any percentage. Robin, do you guys ever recommend a percentage? I've seen a fixed percentage that's saying, all right, we're going to make sure that we're going to spend 3% of our revenue on brand building. Have you ever come across that?
It does depend. I mean, as John says, it depends on the category. It's really difficult. I mean, some brands, BMW is a good example. They've never created brand advertising, but they build their entire ultimate driving machine, sheer driving pleasure through the product, through the way they engineer their product, through the distribution of the product, the way they design them, and the way they actually market individual models. So is that product, or is that business, or is that brand? So I think I think the only answer is it shouldn't be zero. In some organizations, they're so busy kind of focusing on just selling and whatever happens and it's reactive, that doesn't leave any legacy. But hard and fast metrics of what that question means and then where it goes. But a brand, again, yeah, there are brands like Red Bull that are huge, that have never advertised, but they've created, again, coherent experiences, a very strong narrative, and they spend a good chunk of their revenue on building their reputation. But that's events, that's sponsorships. Where do you draw the line? I think that's the challenging part of that question. It's probably a whole debate and a whole summit on its own.
Of course. So I think what we're hearing is there isn't a fixed percentage. It all depends where you're spending the money. Some people put a lot of money on capex. Some people put it on some other phase of communicating. Some put it below the line. Some put it above the line. But I think that the key really, and what I'm gathering from this is, what is that effort doing for you? Is it helping you sell the products, or is it helping you build the brand? And I think that's where probably there would be some clarity and differentiation that should be in the minds of the organizations of how they're evaluating, what KPIs they're setting, and where some of the justifications lie of what I'm going to do where. The ROI measure poll results are actually quite heartening, I would say, because it says my organization have a financial measure only for the brand, and that's 69, only for the business and not for the brand. So that's 69%. Sorry, so that's not very heartening to see. People are not really having any brand ROI measures. We shared some. There may be many others out there. So do adopt one. Doesn't matter what it is, but do adopt a brand measure. I'm going to stop sharing the survey now. So I would like to now, I think in the interest of time, we started 5 minutes late, but we've continued a little longer than we had envisioned to be. Thank you very much. Thanks everyone for joining us. Once again, Thanks, Robin. Thanks, John, for all your contribution. Any of you have any questions to John or Robin, feel free to drop them an email. We will post their emails also to both of you after we've taken the due permission from them. Otherwise, yeah, we don't want to be caught with the PDP violation of any sorts. We will send you the
perfectly fine.
Yeah. Well, so that's a public acknowledgement. John, are you okay if we share your emails?
Sure. Yeah.
So if anyone has any questions, you can share with them specifically. My email address is going to be sent as well. Any question that you may have with us, do reach out to me. I hope all of you had ample opportunity to scan the QR code that was there all this while and make use of it. That's the only place where the full rankings are going to be published, at least for the next few days. After that, it will be removed. Do go to our website, and I'll tell you why, because there's some very interesting analysis and some very interesting dashboards that you can actually generate yourself. You can choose some of the competitive brands that you want to have, and then you can look at some of the interesting outputs yourself. So do go to our website. There are a lot of white papers which are very, very interesting. You can download some of them and read, and it will also keep you abreast about what are our forthcoming events, so you can participate in case you enjoyed this. Have a very good evening, everyone. Have a good weekend, and stay safe. And thank you very much all for joining.
Thank you.